Have you ever wondered how the financial market tries to predict the future? Today, we are going to explore how prices for the same asset in different markets eventually meet up at the exact same point. This concept is a fundamental part of trading, and it is known as the expectations hypothesis. You can think of it like two travelers starting from different locations but planning to meet at the same destination at the exact same time. To see how this works in the real world, let us look at a specific scenario. Imagine today is May 14, 2024. We are looking at a contract for the May 2024 index futures, and we see it is trading at a price of 22,308.70. Now, you might wonder, what does this specific number mean to us on this specific day? This is where the expectations model of futures pricing comes into play. According to this model, that number is more than just a price. It is a forecast. It means that as of May 14, the entire market expects the regular cash price, also called the spot index, to settle at 22,308.70 when the market closes on the last trading day of the month. In our example, that target date is May 30, 2024, which is the last Thursday of the month. You can visualize this process by imagining thousands of investors all using telescopes to focus on one single target in the distance. Every participant in the market is involved in this. Their collective goal is to predict the level of the spot index at one specific moment in time, the closure of the market on that final trading day. This group effort results in what we call price discovery, where the market works together to find the most accurate value for the index at that future point. Because of this constant searching for the right value, we can say that futures prices are essentially the expected spot price of the underlying asset at the time the contract ends. At the moment of maturity, the price of the futures contract and the expected price of the actual asset are considered equal. This leads us to a vital principle called convergence. As time moves forward and we get closer to the end of the contract, the futures price and the actual cash price begin to move toward each other. When we finally reach the maturity date, there can no longer be any difference between these two prices. It is the moment where the future becomes the now, and both prices must be the same. This is the reason why every futures contract settles at the actual cash market price when it expires. Whether you are looking at stock indexes or other assets, this rule of prices coming together on the final day remains the same across the board.